For the first time in close to a year, I just added an entirely new position to my personal dividend portfolio. And in the process of making this addition to my portfolio, I think I made a great choice, but I actually made a small mistake which I want to discuss as well. Now, it's important to keep in mind what type of investor I am. I am a long-term dividend growth investor. I look to buy phenomenal companies that can grow free cash flow year over year because in turn, that will allow them to grow their dividend payments year over year. And in fact, the long-term goal for my personal dividend portfolio is to one day be able to live off dividends. So I need to look for companies that have sustainable competitive advantage, that can grow free cash flow at a high rate and get high levels of return on invested capital. So the idea isn't to maximize dividend income right now, it's to maximize dividend income over the long term. There's a big difference there. But with that being said, I'm not going to make you wait. The new addition to my portfolio was none other than a company I've been talking about somewhat frequently on the channel lately, and that is ASML. I added this company to my portfolio yesterday, and the position is already up 7.44%. And the reason we've already seen such a jump up is this company actually just released their latest quarter's earnings in the pre-market this morning, and on the day it's up about 5.78%. Now there's plenty we need to touch on, such as why was SML a position that I added to my portfolio? Well, to start off, you have to understand what ASML is. ASML Holding is a huge player in the semiconductor equipment industry, but that statement doesn't paint the whole picture. What they're really known for is the development, production, and service of advanced lithography systems. Why is this important? Well, these are essential for manufacturing semiconductor devices. ASML's lithography systems are used by major chip makers worldwide, enabling them to create increasingly complex and powerful semiconductor devices. So right off the bat, we already know they're in an industry, in a sector that is absolutely exploding. In fact, if we look at the earnings projections for this company over the next few years, it's pretty mind-boggling. Yes, they expected to see negative growth in 2024, but look at the projections over the next 5 to 10 years. We're talking about 20% plus projected earnings growth over the long term. And let's put this all in perspective for a moment. In fact, if we go ahead and jump over to my profitability sheet, come up here and plug in ASML. Not only are their earnings projected to grow at a high rate, but look at the way it's already been growing. Look at the 5-year revenue CAGR, 20.29%. Look at the 5-year net income CAGR, 25.5%. So not only are they growing at a rapid rate, but margins are expanding. Look at the 10-year average gross profit ratio sitting at about 46% and last year's gross profit ratio at 51.29%. So again, margins are expanding. But here's what's interesting. If we look at the recent earnings report, there's something else we have to point out. Yes, they did beat on top and bottom lines by a pretty large amount, but look at the outlook. They're expecting a gross margin between 51% and 53% in 2025. So those margins are projected to continue to expand. This is a clear sign of a competitive advantage. And we have to keep in mind, ASML is the only company in the entire world building out these advanced lithography systems. And if we look at the outlook net sales projections, they're projecting between 30 and 35 billion euros in 2025. Again, look at where they were in 2023, sitting at about 27.5 billion. So if we dig into this earnings presentation just a little bit more, there's some key messages we need to take away. To start off, they point out the semiconductor industry remains strong and it's expected to surpass $1 trillion in revenue by 2030. $1 trillion. That's amazing. And because of this rapid growth, the industry will require major innovations to address AI power consumption and cost challenges. And because of that, they anticipate that an increased number of critical lithography exposures for advanced logic and memory processes will be required, which is great news for ASML. And they're now projecting that by 2030, annual revenue will be between approximately 44 billion euros and 60 billion euros, with a gross margin between approximately 56 and 60%. So that's even higher than they're projecting for 2025. So they expect those margins to continue to expand. And then finally, here's something else that should get you excited, especially if you're a long-term dividend growth expector. We expect to continue to return significant amounts of cash to our shareholders through growing dividends and share buybacks. And in fact, if we take a closer look at what they said in the recent earnings report, one of the things we can see is they increased their dividend in 2024 by about 5%. Now, that's not a huge dividend increase, but you have to understand the main focus for this company is currently reinvesting back into the business. So let's go ahead and look at them from a dividend perspective. If we jump over to our dividend breakdown sheet, come up here and plug in ASML. Here's what we can see. For ASML, the starting dividend yield is low. It's sitting close to about 1%. But the 10-year and 5-year dividend CAGRs are obviously no doubt impressive. Now, when we look at the yearly dividend payouts over the past decade, this is actually a little bit more typical for a European company. Typically, when you look at American stocks, you're going to see very steady dividend increases over time, and it's going to grow every single year. but that's not typically the case for European companies. You're going to see more fluctuation with the dividend payouts. Now, if we look at the free cash flow versus dividends paid out, obviously free cash flow has grown tremendously. We can see in 2013, 842 million, and then in 2021 at its peak, it came in at about 9.9 billion. Now, from 2022 to 2023, it trended downwards. But one of the things you have to understand about this company, there's going to be a lot of volatility over the next decade, not necessarily just with the share price, but also with some of the underlying fundamentals. Let me show what I mean. If you look at the quarterly net bookings for this company, since Q1 of 2022, again, there's a lot of fluctuations. In Q3, this company had what most would consider a pretty disastrous earnings report, accidentally releasing the report a day early and also announcing net bookings 50% lower than what was expected. And as a result, if we jump over and look at how ASML traded during that time period, they were over $1,000 per share, and then we saw a huge sell-off, and we saw another huge sell-off here in October. So this company's down about 18% to 19% just in the last year. So again, I do want to warn you, there's going to be a lot of volatility. And it reminds me of the famous Peter Lynch quote, "Everyone has the brain power to make money in stocks, not everyone has the stomach." I'm going to go ahead and tell you right now, if you even consider ASML, you need to be investing for the long term and you need to have the stomach for investing in this type of stock. Now, with the recent earnings report going so well, Wall Street has remained pretty bullish on this company. In fact, if we scroll down, we can see Goldman Sachs. They gave a buy rating with a price target of 1,010 euros per share. We can see Goldman Sachs gave a buy rating with a price target of 1,010 euros per share. If we keep scrolling down, what we can see is Bank of America. They gave a buy rating on ASML with an unchanged price target of 803 euros per share. So even in the midst of a chaotic week, specifically in the semiconductor industry, people still seem to be pretty bullish on ASML. So with that being said, you may be able to understand why ASML fits into my long-term investing plan. So let's talk more about my purchase and the mistake that I made. Now again, I bought ASML yesterday. I added only one share of my portfolio, and I got in at a cost basis of about $676 per share. So again, it's been a nice little spike up already, 7.44%. But here's what my mistake was. I bought in yesterday knowing they were getting ready to release their latest quarter's earnings. And with the chaos in the market over the past week, I wouldn't have been surprised if there was a huge sell-off after they released their latest quarter's earnings, and I thought I was going to be ready to take advantage of that. But I made a clear mistake in trying to predict short-term price movements. And because of that, if I want to buy more ASML stock, I'm going to have to buy in at a higher price. You see, if you're a long-term investor, short-term price movements really shouldn't impact your investment thesis. I have absolutely no idea what this stock will be trading at 1 month, 3 months, 6 months, or even a year from now. But I do feel confident over the next decade, over the next 5 years, this company is going to dramatically increase their margins, dramatically increase their earnings power. And as a result, the share price will follow, and I'll also be receiving larger dividend payments. So if you see a stock that you love that fits in line with your long-term investing goals, and it's trading at a good valuation, you don't have to necessarily wait for that next 5 to 10% drop, because sometimes it never comes. Now, with the new addition to my portfolio, this now pushes my total holdings to about 29. And if you've been keeping up with my investing journey, the goal is to get my total holdings closer to about 25. Now, why is this? Well, we have to remember, yes, diversification is great. It helps you mitigate risk, but also over-diversification can harm your long-term results. When you're overly diversified, you end up putting money into your 50th or 100th best idea rather than concentrating that money on your top investment choice. And this is an important concept that's not talked about nearly enough. If I have a group of 10 stocks that I love and I really believe in over the long term and they fit in line with my long-term goals, most of my capital should be going to those 10 stocks. If I have 100 stocks in my portfolio, I'm putting capital into some of my lower conviction stocks, when that capital could be better used by putting it into my higher conviction stocks. Now, to follow this up, what research tells us is that beyond around 30 holdings, adding more holdings to your portfolio does very little in terms of diversification. If we blow up this chart, we can see on the bottom, we have the number of stocks listed, and over here, we have standard deviation. And you can dramatically reduce risk by getting to around 10 to 20 stocks in your portfolio. But by the time you get to around 30, adding more stocks to your portfolio does very little in terms of mitigating risk and reducing volatility. That's an important concept to understand. So finally, with this new addition to my portfolio, my expected yearly dividend income is now sitting at about $6,270, and my average monthly dividends sitting at about $522.52. Again, the magic of dividend growth stocks isn't in the dividends that it pays right now, it's in the dividend that it could pay in 5, 10, 15, or even 20 years from now. So I'm excited to hold this position for the long term and see what happens. But again, keep in mind, this position will not be for the faint of heart. There's going to be a lot of volatility. But go ahead and let me know what you think of this company in the comments down below. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.